Let's now move on to illustration number 16. WC Limited writes an option in favor of GT Limited. All right. So WC is basically the writer and GT is basically the holder. All right. So it is the holder or the buyer, and WC is the writer of the option, wherein the holder can purchase issuers equity instruments. All right. So GT Limited has a right to buy the shares of WC Limited itself at prices that fluctuate in response to the share price of issuer. Now, what does that mean? It's elaborated in the next paragraph. As per the terms, if the share price of the issuer is less than 50 per share, then the option can be exercised at rupees 40 per share. All right, if the share price is less than 50 per share, then GT will have a right to buy each equity shares at rupees 40. If the share price is equal to or more than 50 per share, then the option can be exercised at 60 per share. All right. So if the market price is greater than 50 per share, it can be exercised at 60 per share. The question is examine the nature of financial instrument. Now let's actually understand this a little more in detail. Case 1 is if the share price is less than 50, if the market price, I'm calling it as MP. Let us say it is less than rupees 50. Then the strike price, the question has mentioned that the strike price is going to be regarded as rupees 40. All right. If the share price is less than 50 per share, then the option can be exercised at 40, which means the strike price will be 40. Now, within case one, I'm actually breaking it further. Case 1A, if the market price is less than rupees 40, if the market price is less than rupees 40, then the option lapses, because if let's say the market price is 30, then then GT Limited will actually not exercise the option. GT will not exercise the option because it's available at 30 per share in the market. Why would it pay 40 to actually purchase the share? All right. So if market price is less than 40, it lapses. 1B will be if the market price is greater than rupees 40, then it is going to be exercised. All right. If market price is greater than rupees 40 and less than 50, remember case 1 is where market price is less than 50 but greater than 40, that is 1B, the option will be exercised. GT Limited will actually pay 40 rupees but will get a share which is worth somewhere between 40 to 50. Let's assume if the market price is 48, it will get a share which is worth 48 by paying only rupees 40. Case 2 is, let's say, where the market price is greater than 50. Market price is greater than 50. Over here also, what the question says is the strike price is going to be 60. The question is saying that where the share price is greater than or equal to, where the market price is greater than or equal to 50, the strike price will be regarded as 60. So here also I can actually split it into two. 2A is a case where market price is greater than or equal to 50 and less than 60, but it's less than 60, the option actually lapses in this case. Let us say if the market price is 53, then GT Limited won't exercise the option because it has a right to buy the share at 60, but the share's worth in the market is only 53, therefore it will lapse the option. 2B will be a case where the market price is actually greater than 60 rupees. In this case, it will be exercised. If the market price is let us say rupees 70, then I have a right, GT has a right to buy the share at rupees 60 for a share which is worth 70 in the market, and therefore it will exercise. All right. So there are different possible scenarios over here. There's 1A, 1B, and 2A and 2B. All right. Now the question is evaluate the nature of the instrument. Explain the nature of the instrument. And obviously, we're talking in the books of issuer, which is writer. This is again a derivative contract. Remember, this is also a call option which is issued or written by WC Limited. It's a call option which is a right to buy for GT Limited and an obligation to sell, obligation to deliver for WC Limited. The question is, will this call option be classified as equity or will it be classified as a derivative? Will it be classified as a derivative financial liability or as equity? Now remember, for derivative, I said we are supposed to evaluate the fixed for fixed test. Does WC Limited have an obligation to deliver fixed number of equity shares for a fixed amount of consideration? Does WC have an obligation to deliver fixed number of equity shares for a fixed amount of consideration? Let us say the number of equity shares, although it's not mentioned over here, let us say the number of equity shares to be delivered is 10,000. Let's say 10,000 equity shares is supposed to be delivered by WC Limited. All right. So fixed number of equity shares for a fixed amount of consideration. The problem over here is the consideration is actually not fixed. It is variable, because if the market price is actually between 40 and 50, if the market price is between 40 and 50, the consideration that WC will receive is 40 per share. The exercise price is going to be 40. All right. So if the market price is between 40 and 50, WC Limited will receive 40 per equity share as consideration. And if the market price is greater than 60, WC Limited will receive 60 as the consideration. All right, it will receive 60 as the consideration. All right, so although it has an obligation to deliver a fixed number of equity shares, the amount of consideration that it will receive is dependent on the market price prevailing at the time of exercise of the option. All right, if the market price prevailing at the time of exercise of option is between 40 and 50, it will receive a strike, it will receive a price of 40 per share. If the market price exceeds 60, it will receive an amount of 60 per share. So the amount of consideration is based on the fluctuation of market price, and therefore it does not meet the fixed for fixed test, and hence we will be considering this as a financial liability. We'll consider this call option as a financial liability and not as equity on day one. At the time of issuance, it will be considered as a financial liability because the amount of consideration that WC is receiving is not fixed, but it is variable. It can be either 40 or 60 dependent on the market prices, and therefore we are going to call this as a financial liability and not as equity. All right. So the contract will be regarded as a financial liability because the amount that we are going to receive is a variable amount. All right. We're going to receive a variable amount of cash, and hence it will be classified as a financial liability.